Hello, everyone, and welcome back. This week has been one of the most eventful weeks for investors in months. Markets had to digest central bank decisions, geopolitical developments, changing oil prices, and continued excitement around artificial intelligence. Here's everything you need to know. The biggest story this week came from the United States. The Federal Reserve kept interest rates unchanged, but policymakers signaled that another rate hike later this year remains possible because inflation risks are still elevated. The Fed's new chairman, Kevin Warsh, also indicated that the central bank may communicate less about future policy, creating greater uncertainty for investors. Initially, markets reacted negatively as bond yields rose and growth stocks came under pressure. Higher interest rates generally make borrowing more expensive and reduce the present value of future corporate earnings, which is especially important for technology companies. For investors, this means volatility is likely to remain elevated throughout the summer. Another major story was the decline in oil prices. An interim agreement between the United States and Iran helped reduce fears of supply disruptions through the Strait of Hormuz, one of the world's most important oil shipping routes. As geopolitical tensions eased, crude oil prices fell significantly, helping reduce inflation concerns worldwide. Lower energy prices are generally positive for airlines, transportation companies, industrial businesses, and consumers because fuel costs become cheaper. Energy producers, however, face selling pressure during the week. Despite the hawkish Federal Reserve, global equity markets managed to recover. The Nasdaq led gains, supported by continued optimism around artificial intelligence and semiconductor companies. Asian markets also performed strongly, while European markets remain more cautious due to concerns over interest rates and slower economic growth. Overall, investors appear willing to buy market dips, especially in sectors connected to AI infrastructure. Artificial intelligence continues to drive capital markets. Semiconductor manufacturers and AI infrastructure companies attracted strong investor interest again this week. Several technology companies benefited from increasing demand for memory chips and computing power needed for AI applications. Analysts continue raising earnings expectations for many chipmakers despite already high valuations. The AI boom remains one of the strongest structural trends in today's markets, but investors should remember that high expectations can also lead to higher volatility. This week wasn't only about the Federal Reserve. The Bank of England kept interest rates unchanged while emphasizing that inflation risks remain present despite lower energy prices. European policymakers also continue to watch inflation carefully as economic growth slows across parts of the continent. Global investors now expect interest rates to stay relatively high for longer than previously anticipated. That could continue to influence valuations across stocks, bonds, and real estate. Several sectors performed particularly well this week. Technology and semiconductor companies rebounded strongly after earlier weakness. Travel and leisure stocks also gained because lower oil prices reduced operating costs. On the other hand, energy companies underperformed due to declining crude prices, while some European industrial companies struggled amid weaker earnings outlooks. Sector rotation continues to be one of the key themes investors should monitor. Several sectors performed particularly well this week. Technology and semiconductor companies rebounded strongly after earlier weakness. Travel and leisure stocks also gained because lower oil prices reduced operating costs. On the other hand, energy companies underperformed due to declining crude prices, while some European industrial companies struggled amid weaker earnings outlooks. Sector rotation continues to be one of the key themes investors should monitor. To summarize this week's events, the Federal Reserve kept rates unchanged but adopted a more hawkish tone. Oil prices declined as geopolitical tensions eased. Global equity markets recovered despite higher rate expectations. Artificial intelligence remains the strongest long-term investment narrative. Central banks worldwide continue to prioritize inflation over economic growth. For long-term investors, the key lesson remains unchanged. Markets will experience short-term volatility, but structural themes like AI, digital infrastructure, and technological innovation continue to attract significant investment capital. No investment week is complete without looking at the biggest stock market movers. This week, technology companies once again dominated the headlines. Several semiconductor manufacturers extended their impressive rallies as investors continue betting that artificial intelligence will drive years of future growth. The demand for advanced chips, AI servers, and cloud computing infrastructure remains incredibly strong, encouraging investors to keep buying companies that are positioned to benefit from this technological revolution. One of the biggest winners was Nvidia, which continued trading near record highs after analysts raised price targets and projected another year of exceptional revenue growth fueled by AI data centers and enterprise spending. Meanwhile, Broadcom also gained momentum after investors reacted positively to its growing AI networking business. The company has become one of the key suppliers for hyperscale cloud providers building next-generation AI infrastructure. On the software side, companies such as Microsoft and Oracle remain strong performers as investors believe corporate AI adoption is still in its early stages. However, not every technology company participated in the rally. Some high-growth software stocks experienced profit-taking after their enormous gains earlier this year, reminding investors that even the strongest sectors rarely move in a straight line. Outside technology, energy companies faced a difficult week. The decline in crude oil prices pushed many oil producers lower as investors anticipated weaker short-term profits if oil remains under pressure. Companies heavily exposed to exploration and production were among the weakest performers in the S&P 500. Financial stocks also traded with mixed results. Higher interest rates usually help banks earn more from lending, but concerns about slower economic growth limited investor enthusiasm for the sector. And that wraps up this week's investment recap. Thank you for watching, and I'll see you next week with another update on the biggest story shaping global financial markets.